Hey everyone, it's Daniel here from InfoVest. Hope you're all doing well. I want to talk about this article here that comes from Zero Hedge. It basically says investors have become super bullish on oil, pile into futures at fastest rate since December 2020. So very interesting to start following how oil prices are playing out throughout the days, throughout the weeks, and throughout this whole year. And I'm going to talk about it in a second of why this is very important to follow and track this. Now let's go into this article, read a little bit about it, and I'll put the link in the description so you can also follow along and read along as well. So basically, the article says here portfolio investors have piled into petroleum futures and options at the fastest rate since the first successful coronavirus vaccines were announced in late 2020. China's exit from a zero COVID strategy, along with hopes the global economy can avoid a recession, and low oil inventories have contributed to an extraordinary wave of buying across the petroleum complex. So, what they're basically summarizing there is saying that you're starting to see more interest, more buyers in the oil markets, and you can see this through the derivative products like futures and options. And we haven't seen such fast pace of buying since December of 2020, right? And why? Why are we seeing this? Well, because you have China opening, right? Reopening, and that can bring in possibility of more demand for oil, right? You also have possibility of also inventories depleting some more. So when you lower the supply and inventories are going lower, then also you've got prices moving up higher as well. And if you have this narrative that we are going to get a soft landing, or we are getting a recession, but it's not going to be as bad as expected, and growth will continue to move up higher, and we're seeing that in the markets. You're seeing that in the stock market, the narrative of some sort of soft landing. That is bullish for oil because it means demand will still stay strong and will continue to be stronger in the future, which means that oil prices should move up, right? That's if you think that. So let's go through this article again. Hedge funds and other money managers purchased equivalent of 232 million barrels in the six most important futures and options contracts over the 6 weeks ended January 24th. Purchases were fastest for any 6-week period since December 2020, according to an analysis of position records published by the ICE Futures Europe and U.S. Commodity Futures Trading Commission. In the most recent week, fund managers purchased the equivalent of 70 million barrels, mostly in Brent, plus 40 million in brackets, and to a much lesser extent, NYMEX and ICE WTI, which is plus 4 million. Now, if you scroll down in this article, it also mentions that, but the wave of buying spread beyond crude to encompass U.S. gasoline was plus 11 million barrels, U.S. diesel plus 8 million, and European gas oil plus 7 million. Refinery shutdowns, so here's the key, refinery shutdowns linked to seasonal maintenance as well as sanctions on Russia's diesel exports are expected to deplete fuel inventories further. So the shutdown in maintaining seasonal maintenance is also going to fuel in higher prices, as well as these sanctions on Russia's diesel exports also will deplete more inventory, which means that diesel prices will move up higher. Diesel prices, and diesel is very important for when you look at the heart of the U.S. economy and many economies out there, especially for the trucking industry. They need diesel, they utilize diesel, and if the inventories are depleting, diesel prices are moving higher, shipping costs could probably start to move up higher, which means what? Which could feed into higher costs for consumers or for the end user, right? Again, inflationary. As I scroll down through here, it also mentions about this ratio. So there's a pretty interesting chart here. If you scroll a little bit lower in the article, it talks about refinery maintenance in the United States is expected to deplete fuel inventories there, but leave WTI prices trailing Brent, which probably explains the differential performance. Hedge funds became more bullish about Brent than at any time since May of 2019, before the pandemic erupted and upended the oil industry. Now, if you look at the ratio, right? Oh, sorry, I think I passed the ratio. Um, the ratio, so a little bit above that paragraph that I just read. If you look at the ratio, there was a strong bullish orientation with long positions outnumbering short positions, right? So that ratio of how many people are long versus short is 5.9 to 1, and that's up from 2.58 to 1 5 weeks earlier, right? So in December, people were less long, right? The ratio of long to short, 2.5 to 1, were less long back in December, and that ratio has spiked to about 5.9. So you can round it to, let's say, 6 to 1, which has been a massive, massive jump. So you're seeing a lot of more money managers going long oil. And again, why is this, right? Well, again, you have the narrative of depleting supplies, should be higher prices. You have narrative of China is basically opening up, fueling in more demand, more growth. That should be higher for oil. The other one is also the biggest one is the recession, right? Now, if you look at the bond market is, and sorry, let's start with the stock market. When you look at the stock market, stock market is saying that you're getting the soft landing and growth is happening, and we're going to see that rates are going to ease very soon, right? And then when you look at the bond market is also pricing in some sort of rate cuts going to come in soon, that inflation will moderate, and that we're going to see an end to the rate hikes, and that we will see some sort of growth that will continue, and that we're going to have some sort of maybe soft landing. However, the oil market is hinting towards, according to this this ratio of long to short, this oil market is basically suggesting that continued growth will cause supplies to tighten and send prices higher. Now, if that's the case, right, if we get oil prices moving up higher, then that means that would be contradictory to what the equity market and the bond markets are saying, that this early stop to rate hikes and that we're going to get the soft landing and et cetera. That would be contradictory to that, because the oil market is saying higher prices, and if it's higher prices, then guess what? That's inflationary. And that's inflationary, especially for the headline CPI, and that will feed into inflation expectation for consumers. And if that feeds into inflation expectation into consumers, especially when they go to the pump and they start feeling gasoline and they're seeing higher prices, and then when you start thinking that that's seeping into the expectations, then you expect higher inflation. And the Fed has told us they don't want the consumers, and especially the expectation of the consumers, to think that inflation is going to continue to go higher and higher. They want that to come down because that feeds into the economy, and you can see that in terms of the spending and whatnot. Then guess what? The Fed has to continue raising rates. They have to be aggressive to bring that down back lower again, especially when you have the media and everyone, reporting that, oil prices are higher again. Or if oil prices go higher again, you could expect that the media would say that. Oil prices are higher again, and look, CPI went up higher again, and blah, blah, blah. Then guess what? The Fed's got to come back, and it's got to slap more hikes right into the market to bring that inflation down and the inflation expectation that is in the consumers' heads. So let's see who's right or who's wrong. Is the oil market right? Is the bond market right? Is the equity market right? One of them's got to be wrong, right? And that's what this article suggests, that we could see we are seeing some discrepancies, and we could see a shift, and one of the market could be wrong, right? And only time will tell. And if you do look at the oil markets right now, how they're trading, today being Monday, January 30th, we are seeing oil prices somewhat dip, although there are money managers who are long, and when you look at the chart in terms of the technicals, you do have somewhat of it, not somewhat, but you do have an inverse head and shoulders formation, which is a bullish technical formation, which could suggest that oil could go to between $90 WTI. Crude oil could go to $90, between $90 to $100 per barrel. So if you got the technical formation plus this fundamentals of more bullish oil investors, and that pushes up oil to that area, then guess what? This next CPI report, whenever it comes, you could see a higher inflation metric, which could cause another panic in the equity markets, and as well as the bond market, and especially if oil continues to move up higher, that will be inflationary. So time will tell. I don't know. I don't have a crystal ball, but time will tell. We'll see what happens. But definitely some alarming signs, red flags. You want to monitor oil prices, see how this plays out, see if the narrative of the China reopening is going to feed into higher prices for oil and so on. And it'll be very interesting to see if that comes true or not. So let me know what you guys think. Leave a comment below. Hit the subscribe button, the like button as well, and the bell icon to be notified on the next video. And I'll see you guys around. Cheers. Bye.